All right. Hello, everybody, and welcome to another Pepperstone live event here over on YouTube. Of course, it's going to be a great event today because we're talking about one of our favorite topics. But more importantly, we're bringing in something a little bit different, Tyrone, and that is we're going to talk about one of our favorite technical analysis techniques for scalping and day trading and really mishmashing that with a whole bunch of other techniques that some of you may know. My name is Thomas Atkinson. As always, I'm joined by Tyrone. How are you going this week, Ty?
Yeah, good, Tom. Good. Looking forward to bringing our favorite technical analysis techniques to the world. We talk about them on a daily basis, Tom, but it's always good to actually refresh and share them with the audience to give them some tips and tricks on how you can potentially make your trading just that little bit more solid. So looking forward to today.
As always, just before we get into what we'll be covering, and I do encourage people as well to put comments down below after the live session, and of course, put it in the chat right now, and we will answer them at the end. If you have questions throughout today's session as we go through the topic learning titles and then we jump into the live charts, make sure to put them in. So we'll be back in just a few moments after this brief disclaimer. So, Tyrone, we always get asked the same question, and that is what's the best technical analysis techniques to use? Should we be using stochastic? Should we be using MACD? Should we be using moving averages? Or actually, should we be just looking at price action? And I think most of the answers usually are based on a mixture of each one. We want to build a storyline, don't we? We want to build a complement storyline, usually using a few different techniques that are separate from each other, and then bringing those across to enhance our trading strategies. So we believe by the end of today's session, you will get some advantage from being able to bring a new technical indicator into your analysis, and more importantly, understand how you could use it along with some other price action and supply demand based techniques. It's so important to do that, isn't it, Ty?
Most definitely. Look, it's all about having the right tools for the job. I mean, it's no different to being a tradie, really. A carpenter's going to use a different set of tools than a plumber would, and an electrician's going to have a different set of tools. Again, it's no different in the markets. If you're trading as a scalper in a long, position or a short position, you're going to use different indicators. And of course, if it's a sideways market, again, you're going to use a different set of tools in a different way. So it's very, very important to understand which tools you're going to use and how to use them in the right market environment. I think it's very, very important and probably an underutilized skill.
All right, well, let's get into something that we get asked for. So, how do we transform our trading strategy and what indicators should we be using? Well, the answer is, I think, over the last couple of years, Tyrone, it's been volume profiles. And we're about to answer why. Why do we use volume profiles? How do trends actually start and finish? And also why it's such a basic yet effective way for us to be able to visualize what Wall Street and larger banks have been doing underneath the hood. We'll be looking at which volume profile is best as well in this section. So let's break down why we need to use volume profiles. And of course, it comes back to the quote we always use here on the channel, which is to understand successful tape reading is the study of force. And I keep talking about this because it's always important to know that we need to understand where the largest traders are, and we need to also think about where they've been position size trading. Now, Tyrone, position trading is pretty much what all of the biggest traders do. They don't necessarily have stop losses like all of us have when we are scalping and day trading in the markets. And instead, they increase or decrease their position sizing. And in general, they actually usually have some kind of open position, don't they? So it's all about understanding when this position sizing switches, and when that switches, when it's going to move to what we call the next level of equilibrium. So a good example of this is something like this chart, which we've shown a few times, but it's got a little bit of a twist today as we're breaking it down. How do large traders actually enter a position, Ty? Well, they do it over a large period of time, don't they? It's not just a short period of time.
Most definitely. And look, that makes a lot of sense, even when you think about it from a logical standpoint, that we're talking about millions and millions of dollars worth of orders here. We're not talking about the retail trader who's entering just a handful of contracts. So although we consider ourselves very important traders, I know that's what traders do, and you think your position is going to affect the market. The truth is your position is not even going to ripple the market at all. But the big institutions have very, very large positions to fill, literally in the millions. And of course, liquidity is a serious problem when you've got that entry point. So what they have to do is break their order down to a few different levels. Just they're going to get an average price, right? So they're looking for, they might consider, as you can see in this chart here, that the 0.71 is the fair value. 0.72 and 0.70 is going to be where they're going to start loading in. You've got your cheap price and you've got your higher price, but on average, they would like the fair value, which is around that middle zone. So it makes sense from a liquidity standpoint that that's how they're going to enter the market. But that is where we get the advantage, because if we understand what they're doing and why they're doing it, it gives us the opportunity to join in and not actually go against what some call the whale trade is actually doing. The whale trade.
And I want everybody out there to think about it of, imagine if we knew where the largest trade positions were placed. In fact, the area where basically the market was really excited about getting into that position, whether it be a bullish position or a bearish position. Could we use that to our advantage? Well, I'm going to say yes, we can, Ty. And
great.
we can break this down. Great. That's great. Yeah. So how are we going to do it? Well, of course, we look at the standard laws of Wyckoff. Obviously, we understand that when demand equals supply, no significant price change and lower volatility. It's just basic economics. You go through school, you go through high school, and they'll teach you something about this. And they'll say if we have equal demand and supply, effectively price will usually remain fairly stable. Whereas if we have a demand or supply mismatch, prices rise or prices drop. Of course, we know this. We also know that volume becomes one of the most important aspects of all our trading systems. And in the past, Tyrone, the problem for scalpers and day traders was that's all great. But when we look at volume, predominantly we'd be using volume more on the daily charts. But now we can read it as a horizontal on the charts themselves. So a volume profile is different to what you may have used before. Traditionally, how does volume look usually on the charts, Ty?
Volume's generally on the bottom of the chart, and you really the daily is probably where you got the most amount of value from it, because realistically, especially in the currency markets, it comes down to which broker you are with, how much volume. Generally, the brokers reporting on their own volume. There's no central exchange for currencies, so it's a big advantage, obviously, to be trading with one of the biggest brokers in the world like Pepperstone, because you're getting an absolute fair price of what the real volume is. But when Tom and I first started trading, we did not have these tools, did we, Tom? Like we only had the old style volume, which really wasn't very beneficial, especially in the currency space. But with the new technology, with the trading view technology, we've got these horizontal volume profiles, which give us so much more information, and arguably far more information than the old volume profile, even in the stock market, Tom, because now we can actually break down what the volume is during the actual bar rather than just the overall volume for that bar. It just completely opens up how you can use that volume and where it was placed.
Yeah, so it's made up of three main things, and that is the value area high, the value area low, and usually the POC, or the point of control. And the point of control is effectively on the screen the most traded zone. So automatically, what do we know? Well, we're finding out effectively where the largest institutions and banks are positioning themselves. Now, how is that important? Well, if we know that level and we can detail that level maybe on a higher time frame, this is something we always made a mistake with when we first got into trading. Let's say you had a 2-hour chart or something. If we know where that level is across a level of structure where maybe demand and supply are equaling each other, then we might be able to scalp around that level or day trade around that level. And this can build the basis of areas or zones of interest. And that's what you should often be looking at as a day trader and scalper. It's not just saying, oh, the direction's bullish or bearish. It's also knowing which area is going to be exciting. Think of it as like chess. You're really trying to think 6-7 steps ahead to say, where is the market going to next, which can be a way that we use this technique. But more importantly, when it gets there, what reaction are we expecting? If we then see that reaction, remember we use these comments: patience, react, don't predict. I love that one. I really do. I think it's a big changer. And I've trained a few people over the years where when we use a concept like that, it just simplifies it. And Ty, it comes back to abundance mindset, actually, which is a really powerful thing. If someone's going to get something value out of this video as well, think about next time when you're placing a trade, how many more trades there are. We're often over trading because we take a bad loss. We take maybe a string of bad losses. And then all of a sudden we go, oh, I've got to risk. I'm going to go crazy. I've got to go get a position in. But if we come from a mindset where we know that there is opportunity on many different pairs and other things, we're just not going to overtrade. And it's really, really 100%. Important.
Absolutely. Yeah, over trading is one of the biggest downfalls of many a trader, and revenge trading, which sometimes is linked with over trading, really does bring you undone. Believe me when I say we are all traders wanting the the best trader's lifestyle. The best trader's lifestyle is not spending 20 hours in front of the charts trading day in, day out. Okay. You want to
Don't do
be
that.
minimalistic, absolutely
Yep.
minimalistic.
You know what we want to do? We want to set alerts. And again, this helps us to do that. So Wyckoff obviously said that there was something called the composite man. And basically this was, if we think of the entire market as basically an entity kind of almost in some ways against us, that represents the biggest players. Again, we want to know where the largest entity is placing their positions. So this is where it gets a little exciting. We can add volume profiles to get entry areas. Here's some examples taken only from literally the last week, just of ways and places that you might have been able to predict that maybe at these areas there would be a reaction from the market. A classic one, everyone loves a good Tesla. And of course, now we've seen a little bit of an upgrade tide. New Model 3s are coming out, which is probably bad considering I have one. It's probably going down. I've lost some money on that trade, guys. But overall, we have a level here. And what you'll notice is what I've done is I've used a fixed range volume profile and I've pulled it across this area. And basically, I've pulled it from kind of the beginning of this whole structural setup over here all the way down to where it was over here. And whether you pulled from this area here to this area here, or you pulled the whole area, what you'll find is it's clearly on the histogram on the left-hand side here, this is the most traded zone. So does it make sense that when the market came back to this level, that there would be a reaction there? I believe absolutely it would make sense. It's also something else we'll look at very soon here on the Pepperstone YouTube channel, which is, of course, supply and demand. This is a level of supply. So we have a level of supply followed up by a pretty interesting level of point of control, the most traded level. So if you were a day trader, what could you have been doing in this area? We could have been looking for potentially some shorts. Now, if you have a system based on indicators, let's say some moving averages or stochastic or RSI or Bollinger Band, plus some price action switches, if you saw a short there, could this give you more information, Ty? What do you think?
Oh, most definitely. Like you're highly alert for the potential level 2 short, but just as importantly, if you're longing from that position, where you'll be looking to take profits as well. It's not just about entering a trade; it's also about exiting a trade. Like knowing that there is going to be problems in that area. That is the area you want to be leaving the market. So not only does it give you an opportunity to enter, but it also gives you an opportunity to exit. Understanding where the market is more than likely to go because of the point of control is an extraordinary advantage. And for both levels, for buying and selling and taking profit and entering position. So realistically, when you know that area, traditionally we would have called that a point of resistance, but the volume profile gives us real information on what's actually happening in that period.
Yeah.
And the volume tells us everything we need to know about why that price action is actually there. Don't forget, sometimes when the market moves very, very quickly, it doesn't necessarily do it on big volume, where this particular instrument tells us where the volume really is. And I think it's just a huge game changer, really.
Yeah, and this is taken before the fact of it coming back. So what I've done is I've pulled from this side here over the whole area, and you can see how it's interacted with this zone. It doesn't mean it will interact, but if it does interact with the way that you were playing the chess, the way that you were playing the Queen's Gambit or whatever, I think that's a chess move. So anyway, the area there, if we see the market come in and we basically, actually, I know another chess move, the London system. That's what we're going to do.
The London system.
We play the London system. I think it's aptly named for this particular pair, the Euro USD. And if the market comes up and we see a short, then of course we're going to know, that's where they place large positions. They might be defending that area, and therefore we can scalp and day trade on the smaller timeframes. And I'm not on an obscenely high time frame here. I'm just on 2 hours. So there are some good volume profiles to use. Fixed range volume profile, we use that in the examples today. Visible range, what most people use, I actually think it's a bit poor, which is basically what it will do is it'll just move the volume profile to whatever screen you're looking at. I really like to be more precise in our technical analysis techniques. And then session volume, which is pretty useful for day traders as well. So Ty, whenever we also think about volume profiles, we always need to go with the idea of what is the ultimate trading duo? What is volume profiles with another price action, supply demand, or even indicator-based method? And I'm going to go with volume profiles and supply demand strategies whenever it comes back to this one. And the main reason is because I want to know where the level of equilibrium is in the market. And I want to obviously then be able to apply it. So it's always about understanding also when we're using volume profiles and we're thinking about supply demand, what are we looking for, Ty?
We are absolutely looking for the biggest and ugliest pairs to trade, where the real volume is, where the real traders are. We're looking at things like gold. We're looking at all versions of gold, the Aussie gold, the US dollar gold, the euro gold.
Yep.
We're looking at the US majors. We're looking at the Aussie USD, the euro USD, the pound yen, of course. And we're going to be looking at the big key indices, okay? The NAS. We've got the S&P 500. We've got the Russell. We've got the Aussie market. We are blessed with so many different instruments that you really want to be sticking to the biggest and the best, because that's where the real, I mean, at the end of the day, the volume needs to mean something, and supply and demand has to be important. It's going to be no more important than on the biggest pairs and of course the biggest indices. So it's really, really important to focus on these ones, especially when you're first starting out, because you're going to get all of the clues that you need, and you know that it's actually meaningful.
Yeah, it's all about the huge volumes that go through these pairs as well. Liquidity must be present. If liquidity is not present, then we're not going to necessarily have as much advantage from a volume profile technique. I mean, if there are not large trades being placed, and also a lot of retail traders like you and I out there, then that's going to be an issue as well, because we need, I guess you would say, fish out there, Ty. And we need some fish so the whales can eat them, or krill. We're the krill, so the whales can eat us up. But in this case, we're trying to fight back. And how do we fight back? Well, we find out where the whales are, and then we can spot them. So
don't the krill eat the whales? I thought they ate the whales. What eats the
krill
whales?
Eat the whales? I don't think the krill eat the whales. The whales eat the krill.
What attaches itself to the whale?
I don't know, little cleaner fish. Okay, yeah. It's like a shark, the cleaning fish thing. Yeah,
yeah, we're the ones that
we're like that.
To the whale. Yes.
We're following along. So if we get here accumulation, obviously we have demand zones, we have supply, and we have distribution zones. And we've used this chart a few times before. But what we're interested in is actually knowing that when sometimes markets will come back to key levels. So you'll notice in this case, we have a trend up. And what that is it's a break of a demand zone, and the market goes doot, 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 and then it stops kind of in the middle of nowhere, well, what seems like the middle of nowhere, and it goes doot, 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 doot. Now, what isn't marked on this chart is, of course, that is actually a level of demand. And if we picked a volume profile from here all the way to the high, so from the low to the high, I bet you the most traded zone is right there. So therefore, that's going to be the point of control. Then the market comes back down and reaccumulates around that level. If we were a day trader or a scalper, what zone would we be interested in seeing a reaction from? Right there. And we can probably make that delineation before. You know, the beauty of this, Ty, is it keeps us in the trend. It looks like the market's obviously done a trend up. So although it's distributed, still the trend is probably begin going up. And although we don't have the other market information here, what if the trend had been going up for some time? We do prefer to scalp and day trade in the direction of the overarching trend, whether this is a day or a 4-hour or whatever else time frame, but this would be an exceptional level. So certainly using volume profiles from this action standpoint can be quite powerful. We also need to, of course, know that the fish thing here, that we are the small fish or the sucker fish. We want to go and join on with the kind of the sharks and the whales.
We want to jump on the whale. Yeah.
I
will find out what that fish is that attaches itself to the whale. But that's
okay. Someone in the chat, I'm sure someone in the comment section will put that down below, and that they'll school us on everything to do with plankton and whales and fish. In forex, commodities and stocks, market makers and big banks and institutions can never place their full position at any time all at once. So we know that already. So really, what we're doing here is we're looking for these areas or zones, and then we're going to pull our volume profiles over the top of them. So what if we knew that through all of this structural area, the most traded zone was here? Okay. What if we knew that? And I would say it probably is based on the price action I'm seeing here on the charts. There'd be a decent amount up here, but let's just say, what if we knew all of it was in here? Then we could be looking for smaller time frame trades in this area. And as it turns out, you know, we don't know what the time frame is here, but there is a nice little switch of trend that happens over here on the right-hand side, which then starts this rally. If this was a 5-minute chart and we knew that the most traded zone was right there through the hit, and we then see a reaction to that, that's going to be awesome. That's exactly what we want to be looking for. And once we get our catalyst on the smaller time frames, then we can say, okay, we know that it's come back, it's hit the most traded level. We need to join in with the sharks and the whales, And therefore, we're going to go basically in that direction at that point. We've seen the reaction to the point of control or the volume profile. Very, very important. So all of these things become, really the areas that we want to be focused on. Here's a classic case of how supply and demand theory can come together with volume profiles. This is what we call a drop base drop. So basically, it's a market that is going down and the trend is down. It bases, forming what looks like in the end distribution. We don't know that at that time. If you're a day trader or a scalper, though, if you know that this area is now a supply, as it comes back up into this, what we might want to do is go over here to the left-hand side and pull what we call a volume profile. So we can pull a fixed range volume profile over this structural base. And once we understand that, then as the market comes back up to that level, if it touches, let's say, the POC or the value area low or the value area high, which are parts of volume profiles, they could be reacted to. If they are, what are we going to do, Ty?
Well, if we're looking for a sell, we're going to sell, or if we're long, we're going to take profit there.
Exactly. So again, it gives us our entry potentially, and it also gives us a potential take profit zone, the power of why we might use this. So here's an example, again, just of showing you a volume profile returning to supply. Here's our supply. Here's the return to supply. And you can see here, it's a little bit of reaction to the point of control, but there's a ton of reaction to the value area high. And we end up getting a little change of trend here on the smaller timeframes, although this is a day, there's smaller timeframe change of trend here, and a beautiful little short that you could have taken around that 1975 that leads on to a very nice trade indeed. So again, pulling the previous structure of markets, getting an idea of where the big banks have positioned most of their positions in, and then seeing whether we get a reaction to it. A super powerful day trading and scalping technique. So here's exactly how I would do it. We would box this area up after we get the POC and the value area high. We would say this area is therefore our supply that we think there will be a reaction to. The market comes up to the area that most people are probably going to try to have a go at it. It then induces through, comes up to the second extreme, gives the reversal. And if you have a great day trading little kind of setup in there for that reversal, once you see the reversal, we can have the patience to then react and not predict. And we can basically put that one through. Once that happens, we can also then use volume profiles to figure out where we think maybe target markets will go to. And you'll notice that at the time this recording, it's done, it did this. So we're sitting around here. So it's possible that we might still go down to an 1840, but we're also going to have pretty strong resistance around the 1960. So we know 1960 is strong resistance in that area. And we also know that 1840 would be very, very strong buying should the markets come down. So of course, we could set an alert down here and say, well, I might want to come back and revisit gold, Ty, if it hits 1840 in the future, and maybe do some day trades and scalps around that zone. There's no harm in just setting alerts for the future and knowing that if it comes to that zone, you'll be like, oh, yeah, I forgot I set that a month ago. But at least now you're being alerted to it. So set alerts whenever possible. A great technique, isn't it?
Oh, most definitely. And it's a pleasant alert. It's not like an alarm clock waking you up at 5 o'clock in the morning. It's an alert that's going to give you an opportunity to potentially trade. There's nothing worse than missing out on trades, Tom. And if you haven't got your alert set, it's no point coming back a week later saying, damn, that was a good entry. So
it sucks. It sucks when that happens.
Yeah. No, your trader's best friend. So and these days you can do text messages, everything. You can actually set alerts.
Yes,
email or a text message, whatever you poison, really.
You just couldn't do this in the past. I mean, it just wasn't. No. It was actually a really expensive service. I remember you used to pay $20, $30 a month minimum just to get something like 200 alerts sent to you. That's how much it used to cost back in 2010 and 2009. Even maybe up towards $100 because you had to pay 50 cents to $1 for every text message, if I remember rightly. It was pretty wild.
Trading tools have never been more accessible and more easy than they are now. Like it's a wonderful, wonderful world we live in now, because it was very, very different back in 2007 and 8 when we first started.
So, of course, again, fixed range is the preferred use here with supply and demand. We pull from the previous swing to understand the price might come back to. Just an example to summarize here today. If we have a market that's done this and come down, then what we'll do is we'll pull from the high all the way to the low. We'll use a fixed range volume profile in this case. You're probably going to get some kind of point of control sitting around here with the value area high. You draw a box in that zone. And as the market comes back into that area, it would more than likely be a decent profit targeted zone, but more also would be that there could be a great entry criteria there. So again, you just find these levels as they're happening, set alerts. When the market comes back to it, you might just get a little kind of alert. Whoa, okay, today might be the day I trade euro pound or pound US dollar or S&P 500, whatever you've set up. So the volume profile that no one uses, Ty, the hidden secret, the hidden gem, I would say, of trading has to be session volume profiles. And if you haven't heard about it, you've got to stick around and check this thing out, because session volume profiles, when they're unleashed on the market, they can be pretty good. And they're very good for day trading and scalping techniques to find areas of illiquidity, okay? Finding areas where markets have moved maybe too quickly and they've got to come back and fill that zone. There are a lot of areas out there in the markets, Ty, where people believe that there is something called inefficiencies in markets. And basically that is like a gap of volume or liquidity, which is where the market needs to come back, fill that, and we can see it with the session volumes. We first see these types of things usually with gaps. I mean, gaps have been around in stock markets forever. And there's some stats, I don't know if you know the stats. What are the stats you've always heard about gaps? How often do they fill?
The gaps fill, I think it's around 80. I mean, they do change constantly, but generally 80 to 85% of the time a gap will fill. And that's very important information because, yeah, realistically, it's a trading method in itself, isn't it? And look, it was more prevalent when there was probably less volume. I mean, the more liquid a market, the less chance there is of a gap these days. But what it actually does, though, it means a gap is actually a significant event now, where in the past, low volume, low liquidity is going to cause a lot more gapping, and therefore, I guess the opportunities are there, but they may not be as solid. A serious gap now is far more important than it used to be because the markets are so much more liquid than they used to be. So definitely a trading strategy in itself. And yeah, look, there's all sorts of ways to play it, but understanding why it happened, of course, is very important.
Not all gaps are even equal though, Ty.
No,
So
they're
I
not.
mean, at the moment, I would say the S&P 500, if you look at a chart at the time of this recording, would be one that's left some serious gaps behind on it. Anyway, what we're interested in doing is when we're talking about sessions, we want to know, of course, what session we're going to trade. Are we going to be a US session trader? Are we going to be in the overlap between the London and the US session? Or are we going to be in the Asian session? Which one are we going to pick does determine which instrument is going to be best. Remember, you need to trade instruments of liquidity around times. If you're going to trade the London session, Euro US dollar, gold, pound USD, indices from Europe, Eurozone can be very good. The overlap, perfect area for you to be trading S&P 500, Russell 2000, NASDAQ, and of course, still the pound and the euro. And generally the beginning of the pre-London session, and I believe at least anyway, the beginning of the US overlap, that is probably the best liquidity period and probably some of the best trading for day trading and scalping. So as we mentioned, we've got three types. We've got the fixed range, the visible range, and the session volume. So which one should we be looking at? Well, we want to always recognize price action. So we need to know when we're in trends and stuff and things like that. So if we are in a series of troughs and peaks and higher troughs and higher peaks and higher troughs, et cetera, then we're in an uptrend. If we're in a downtrend, then we're in a downtrend. Obviously, we can figure that out pretty easily. I'm sure most of you all are very well aware of that. But when we start to add that in with session volume profiles, we start to get a little bit of a different picture. So not only can we start to say, okay, the trend is down or the trend is up, but we can also see these periods where you get these giant candles. So here's a 2-hour chart, and there's two massive candles. Now, I always ask people in the comment section and here today, what do you think caused these giant candles? And Tyrone, I'm going to let you answer. What do you think did it based on what we're seeing here?
Well, it can be all manner of things, but a lot of the time it can be news, generally an announcement of some description. But what is very, very important, and this is what leads us to what we're talking about today, is these candles aren't necessarily caused by big amounts of volume. Okay, so
Yes.
they are triggered by an event, but they're not always caused by a big amount of volume. And this is why having the volume profile on the side is so important, because it really gives you a really good understanding where the real money was, where the real contracts were, where the real liquidity is. Sometimes when the market actually moves very, very quickly, you might be very surprised at how many not so much gapping, but prices get missed on the way up or on the way down, because there's just not enough orders to actually fill them. And the volume profile gives us that distinct advantage of understanding where those orders were and where that liquidity actually is.
So we've all seen this. If you're at a non-farm payrolls or something like that,
Love
or
non-farm.
another event. Yeah, love non-farm jobs numbers in the US, by the way, if you don't know what non-farm payrolls are. Or you've traded, some other large liquidity event. Oftentimes markets will spike off into the horizon or below, and they'll always go the wrong way. You don't want them to go, but more importantly, they'll often be so quick. So you'll be watching it on a 1 minute chart. The news will come out and then bam, it's gone. And it's gone like 50 pips or something on FX. And you're thinking, what just happened? What happened to my trade? Where did this go? So as Tyrone mentioned, that doesn't necessarily come along with a lot of trade. In fact, it could be very thin. So here with the session volumes, what you're looking at is an incredibly thin market through this candle, which means that this wasn't really fair price distribution. So it's a good chance that the market will come back down and at least hit back up into those previous wicks. And this is where you get these wick to wick touches and things that people talk about. So the market comes back down here, and you can see it reacts to that zone and, of course, rallies off it. Now, it's not guaranteed that it's going to have to come down and hit this. But what you could be saying is, if I have a short, let's say I've shorted up here due to resistance and some other things on the smaller timeframes, a great take profit target would be to look at these previous highs and to also understand that there is a severe illiquidity that went through then. So it's probably going to come and clear that up, which is exactly what happens. The session volume profile helps us to do that. So if you ever see these types of illiquidity events where markets have gone off very quickly, and then let's say you're in a short, you could then say, okay, well, let's put a session volume profile in there. Oh, wow, that's a really thin level. Maybe I want to consider that the market might want to fill that to give us fair distribution. So in this case, that's what we end up getting. And you'll see it happen time and time again on session volumes. Here's another example of a giant piece of news. And it went a lot of trade up here. You can see the histogram, massive, and then absolutely nothing. And it goes boom, all the way back down. And then all of a sudden it has to come back to fill all of that. So definitely this area in here probably needs to be filled. It ends up going a bit higher than that, but it's fair to say that this range in here was fairly decent pickings. And you can actually see the market reacts to that zone where it starts to pick up in volume again. Nothing in here. Very likely it's going to go back there if you are buying the base and you find a replicable strategy down there. And it's just a great way of seeing it. And of course, there's some other thin volumes over here on the left-hand side in this example, which we could fill. And we do end up filling. And again, where does it touch? Look at where that histogram. I don't know, you can't see it because we're over the top of it. So let me just fix that for everyone here. There we go. And you can see that we have a very nice touch to that zone. So it's just an example of a way that we can use this powerful technique with our day trades and our scalps. And I'm sure many of you out there that are watching this video right now are thinking, oh, that could be pretty cool. So absolutely, it's something we want to be doing and we want to focus on it. Here's another example of fair trade gaps. And we've got over here on the left-hand side. And of course, we have the market coming down to that level. Now, after this recording, it actually ends up doing this for a little bit and it comes back down. And you'll notice that we have a 43.40, 43.30. So what it actually did was this, just out of interest. Kind of, well, not that low, but, it basically came up. And at the time of this recording, we're sitting in this area here, which just so happens to be around a point of control of the whole trade down. So it's funny how session volume profiles and also these fair distribution gaps and everything else, they can just help us to understand where the big players are sitting in markets, can't they, Ty?
Absolutely. And it's a very, very important concept and element of trading, because knowing where the real money is, where the big traders are, remember, we've said it many, many times in previous videos and previous webinars, if you have an understanding of where the real market is going, you want to participate in that move, not against it. Okay, so when you're putting your odds in your favor by actually trading with the whales, if you're eating the
Mhm.
whale skin, you are going in the whale's direction. Very, very important.
So we need to summarize this, Ty, and that comes back to how we're going to use these session volume profiles. Well, we can use them for take profit levels for day trades and scalps. We can use them for entry areas as well. So when we see that kind of liquidity gap kind of filling, then we can say, well, maybe there's going to be a reaction here. Again, if there is a reaction with your day trading or scalping technique, can be very, very good. And of course, it allows us to see most traded zones more clearly. So we can, again, just see where the structure of the market is setting up. So, if you enjoyed today's video so far, Ty, and you enjoyed what we're doing here on YouTube, I'd like to say to everybody, please give it a thumbs up. Also, let us know in the comments down below that you do like this stuff and that you appreciate Pepperstone putting it on. We do it every week. So that means that we'll be coming at you again next week at the same time, same place. But let's actually jump into some charts and kind of answer some questions here. So I'm going to go over to the room and oh, I'm gonna probably, hopefully, get rid of that sound. There we go. All right, I'm going to mute this up. So let's answer some of these questions. So Charlie has been very patient. Says he wants to have a look at the Nasdaq. So sure, we'll take a look at that. So let's do that one first up. Nasdaq, and the request was for the 4-hour tie.
4
So
hour.
let's have a look at the 4-hour. So in fact, let's actually pull some volume profiles. Why not? We're here on the Pepperstone platform. Trading View is what we're using here. And we're going to use a fixed range volume profile. Just have a look here at what's going on. So one example could be we could pull from a high to the low. You'll notice that we're trading around the most traded zone from the high to the low. So basically, where are we? In some ways, we're at kind of fair value. So the market is deciding whether it wants to boost to the next level of equilibrium or whether it wants to sell off. So an example here on the 4-hour time frame would be if we take a 15,322 low tie, which is the low here, have we possibly changed trend for a swing trader? What do you think?
Yeah, absolutely. And I think that's the clue that it's giving us. It's a level of decision making that the market hasn't made. Let's make that very, very clear. The market has not decided where it's going here. All we know, it's returned to a zone where it's heavily traded and there is a lot of accumulation or potential distribution here. So if it breaks higher, of course, we've got the next target set, and you can see the volume up there. You can see a big the volume spike right where we would expect the market to go, which is obviously really, really important. And on the way down, we know also where the real volume lays. And that's going to coincide with a good level of support. If you do your normal standard classical technical analysis, you're going to find standard support zones at those levels as well. 15,000 being a very, very important round number, obviously, a
Mhm.
psychological level. So what this is telling us, it's not telling us the actual direction just yet. It's giving us the
Yeah.
warning signs that if you're long, it's an area where you could be potentially taking profit. But if you're looking for an entry point, it's giving us the area where it needs to break out of to actually join in with the next big move up. And I think that's why it's so important to understand this, because it gives you the opportunity to take advantage of whichever way the market moves.
Yeah, and I think also we need to understand that most likely this giant candle here is quite thin. So that means that it's going to show you that there's actually very little trade going through that. So the value area low also sits on a level of demand on the small time frames. So if it does get through here, unless it just instantly rejects and says, haha, we've induced, we're going off, it's more than likely it's probably going to try to trundle its way down to like a 15,000 kind of 50, 15,100. So yeah, the Nasdaq is a very interesting trade, but and if you want to find out more about this, you can always go and jump over to fxevolution.com, which is of course where we have some trading courses on. The day trading masterclass literally covers this in way more detail
Mhm.
and brings together a whole bunch of things. But let's answer some more questions here, Ty. The next one is Raj says, I find timing very important. Biggest movements occur at the opens of the markets. Well, that's true. We get the liquidity coming in. Usually, you
Yep.
want to jump into the charts about 45 minutes to an hour before. Make sure you've got your set alerts for all of the key break zones that you believe could happen, or the key reversal zones to maybe some points of control. And if that does happen, then you'll be pretty excited. But yes, liquidity around opens, usually there's the most news coming out as well. So
Yeah.
that's why you'll often see the biggest trades around the news, won't you, Ty, which is that open.
That's right. Yep. And probably leading on to LT Smash's question from that, would you trade before the news? Personally, LT Smash, we do not do that.
Generally not.
Primarily because you're guessing, right? Like at the end of the
Mm.
day, we don't really know. No one really knows which way the news is
Yeah.
going to react. Quite often, you get violent spikes that are going to take out stop losses and then potentially go in the direction that you wanted to go to anyway. So we always found, look, we used to, look in the day when we had our cowboy hats on, nearly 15 years ago now, or 16 years ago.
That was exciting times.
It was exciting, and we attempted to play the news game, but we quickly learned that for every win that you get, you're going to take the losses with it, and it's really it's a bit like technical analysis gives you an edge. If you're trading news, that edge is lost. Okay, and I think that's probably the important lesson in that. When things settle down, very, very different story. So I think that's really, really important. And just like the Wise Ninja says, we would trade after the news is settled. Absolutely, because that's when the market starts to return to these key levels that we're actually talking about. So it's very, very important. And the Wise Ninja also says that this is actually some great info. Thank you very much for that, Wise Ninja. We appreciate that comment, and we certainly hope that it is beneficial. Because look, we find that it helps in whatever trading style you use. You can be a scalper, you can be a sideways market trader, a supply and demand trader. Using the volume profiles that we've discussed today gives you an advantage in every market. So I think it's very, very important for that.
Yeah, and I think also when you're talking about trading news, non-farm payroll is a good example on the Friday before this recording. So again, check it out. That would be, what was it, the 1st of September 2023. That's right, I think.
It is. Yes.
I forget the date sometimes. But yeah, generally you saw the markets go bullish, and then all of a sudden the markets went bearish. And I'm talking from the S&P standpoint here. But basically they went one way and then went the other. Often that is inducement of liquidity. So often you will actually be able to sometimes spot where the market might go to. Think of the chess game, and the market might actually go there. And then you'll say, oh, I can react to that now. And then you'll see this huge pullback or huge move to the opposite direction. So yeah, inducement is a big thing here. Would trade after the news is settled? Absolutely.
Our man Stewie Mack's got a question for you, Tom.
Stewie Mack, where's Stewie Mack here?
Does it always consolidate at the POC, or does it hit and move?
So yeah, you don't really want consolidation at the POC if you can help it. So ideally, this wouldn't happen. So what's happening here on the Nasdaq's a little bit not good because you want a strong reaction from the point of control. Effectively, you want it to go boom. Okay, we're going to react and push it down. There can be structural movements like there is right here, but the problem is this opens you to both being bullish and bearish.
Exactly right.
And you have to say now I'm more neutral until I see the break either way. And when I get the break, I'll be able to scalp it in that direction. So in this case, I prefer getting hit and move. But
hit and run, Stu. Hit and run.
Mr. Om says nice redistribution. I assume he's talking about one of the slides from before. And then we also have any advice on extensive courses on trading, what to stay away from. Well, Dan, you have come to the right place. I would have to recommend our one, which is literally this plus a whole bunch of others. If you want volume profiles, do the Day Trading Masterclass. If you like Swing Ultimate Masterclass that we have. And then, of course, we also have some group mentoring as well if you're interested in that stuff. And Charlie says, thanks. No worries, Charlie. That's awesome. Thank you very much for coming. And hopefully you gave it a thumbs up. I'm going to give it a thumbs up while we're here, Ty.
So am I.
It went to 29. I expect it to go to 30 now if you actually did thumbs it up.
I did. There we go.
But anyway, very good. So, as always, join us next Wednesday for another one of these sessions. Make sure as well there's a pinned comment that says, thanks for joining the session. Click on that and be alerted. So put your details in. I'm pretty sure it's really simple. And you'll be able to then be alerted when we go live for these sessions as well. And I think we give a lot of value here to the community. I hope you guys feel the same. And Tyron and I really enjoy, of course, this passion of ours, which we've been doing for a long time. So if we're still passionate after 15 years, that's saying something. We like it very much. And it's like anything else. LT Smash says here, Ty, before we go, he says, how did both of you find day trading in the Asian session? And personally, I find day trading quite tough during the Asian session. Yeah, it is quite tough. It's kind of like watching paint dry sometimes. There are days when it's exceptional and days when it is poor. I'll be real. It is technically better to trade I would say the London and break session between the US and that gap session
That's where the
between the
liquidity
US.
is. Yeah, it can be
Yeah.
very, very painful in the Asian session.
I would say probably the Asian session. I would prefer just to look at the closes of what's
Yeah.
happened on the day, and then they do more day break strats, or just do swing, or trade the ASX 200 or one of the Asian markets, because you'll find a lot more liquidity around there, which of course you can do inside of the Pepperstone platform as well. We've got a bunch of stocks there, which is awesome as well. All right, Ty, any other final comments you want to say about that, or you're pretty
I just
good?
want to give a really, really big shout out to everybody who joins us. I know we're doing this every week. We're trying to bring you as much
Yes.
content as possible. We really appreciate that Pepperstone is giving us the opportunity to come to you on a weekly basis, because I think we get a good continuity, and I see a lot of familiar names there. We do
That's
really
awesome.
appreciate your time. Thank you so much for giving us your time. We do
Yes.
love teaching. We are very, very passionate about it. We've been doing it a long time, and we love to see the same people hopefully learning. We see Hyro there. Thanks for your comments,
yes.
mate.
Thank you.
We are hoping, and James, everybody, the whole party's here. And we are really looking forward to seeing some of you in our Vegas conference. We are 17 days away from our Las Vegas conference, our very first international conference. If you are in the vicinity, definitely come and check it out. We've lined up some of the best speakers in the world, and we love meeting people in person. Anyone who will attest to our conferences who have been there in the past will say how much fun they had, and we do love and really look forward to meeting people in person, of course. But look, thank you so much again for joining us tonight. We come at you again next week with another live session. We'll analyze the markets again, and we'll have a new topic. And yeah, thank you so much again, and we look forward to seeing you next week.
All right. Well, from all of us here at Pepperstone, thank you so much for joining us. We'll see you next week. Bye for now.